we just can't seem to optimize our straddles. We know that you don't go for 50% because it's too damn hard. So maybe you go for 25%, but that's how we were trying to optimize it. So we asked the research team to kick it up a couple notches, try to figure out, is there a way to optimize straddles that we haven't figured out yet? And they came
Good.
up with,
I'm glad they're doing this because I would have said 25%. That would have been my
okay, then you're gonna like what we came up with, because it's not that 25% is wrong. It's just that I think we came up with something even better.
beautiful. I love it.
Let's
Can't
take
wait.
a look. Go to the next slide. Since straddles take more time to reach 50% of their max profit, we prefer to manage them at 25%. The goal is to improve the mathematical probabilities of your trades and work towards a positive expectancy over time. So managing straddles at 25% of max profit fits well within a broader strategy of frequent disciplined trade management to compound gains and to limit outlier losses. So with strangles, managing at 21 days provides a number of benefits, including more consistent performance, lower portfolio volatility, and reduced delta and buying power expansion risk. Also obviously, reduced outlier risk. Does this imply we should manage straddles
That's what she said.
in fewer days than strangles, even in different IVR environments, to get optimal? What do you think about that? Does it imply we should manage in even fewer days? Our default is always to go less than more.
With that premise, it would make sense. Sure.
Okay. And here's where it gets really interesting. Same stuff as we always do. 45 days to expiration, managed to 21 days, 2010 to present. So plenty of history, all in the SPY, 50 delta straddles. We calculated the average P&L, the daily P&L, the win rate, the standard deviation, CVAR, basically everything. And we used varying management strategies, 14 days, 22 days, and 30 days, with the IVR over and under 30.
So look at high implied volatility, low implied volatility. 30 is the threshold. That's what we look at.
Yeah, and 14.
It's a pretty standard. This is really a pretty standard.
Let's go next slide.
What's the wine rate? Just curious what that one is.
That's when you go to Napa. Yes. That was an extra E that hit the wrong column.
Got it.
They do rate wines, just so you know.
I know.
So although the average P&L scales with time, win rates stay consistent, and we maximize daily P&L by managing at 14 days. This is all the days. So this is not by sorting by high IVR or low IVR. This is just taking all the days, all right? By managing at 14 days, the numbers came out. They were a little stronger because you could look at the daily P&L, but the CVAR was still high, and the standard deviation, which is kind of measures your risk on the trade, that was still high, but your daily P&L was good, your average P&L was good, your win rate was good. But off this slide here, you would still go towards 21 days or even 30 days, just because you would want, even though your daily P&L was a little bit less,
daily P&L doesn't mean as much, because
you want the lower CVAR and the lower standard deviation of risk.
Exactly, but the daily P&L, you would expect the daily P&L to be higher earlier in the trade because you're collecting more from the very beginning, right?
No, not really. Your theta would actually get bigger as you went closer to expiration. It's just that there's a lot more losses built into the back end of it. That's what lowers the number. But it's the standard deviation of the risk in the portfolio and the CVAR that scare me in this one. If you go to the next slide, do we also see an increased long-term performance from a portfolio context? Let's go to the next slide. Managing at 14 days, and this is what was interesting, provides the cleanest cumulative P&L increase while also cutting losses or curbing losses. So what this means is that over time, what happened was when we looked at the cumulative results, okay, and being able to kind of redeploy capital, it was just way cleaner because you eliminated those drawdowns on the back end of the numbers that we showed in the last slide. Does this also imply that we should manage straddles in fewer days than strangles, even in different IVR environments? And this is where it should get really interesting. What happens here is that when IVR was less than 30, managing at 14 days showed optimal performance, where it maximized daily P&L, blah, 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 and all the other stuff. So what we found here was the average P&L of $17. And this is the same 45 days. The win rate's the same. The daily P&L is still higher. And the percent of P&L over the initial credit was higher. So this became a very interesting slide when you had IVR.
Lower implied volatility rank.
Yes. So when the IVR is over 30, I thought we missed it. The performance across the board shows the P&L scales with time and the win rates stay consistent. And then we maximize the daily P&L by managing it 14 days. What this showed, you actually have, this is high IVR managing straddles at 14 DTE. You had the highest average P&L, the strong win rate, the highest daily P&L, and the highest percentage of P&L over. Like, go back one slide, John. So this is the IVR is under 30, right? And this is where you end up with the P&L 17 compared to 25 and 29, and all the other numbers they're much smaller. What this is basically suggesting, Tony, and if you go to the next slide again, John, number 9, you end up with huge numbers relative. So what this is all suggesting is that if you're going to sell straddles, you want to do it in high IVR. Don't even consider it in low IVR. You want to do it in high IVR, and you want to do it where you manage the trades in 14 days as opposed to waiting longer for 50%.
Right. And normally, when we're looking at a strangle and it works, it's usually in that 3-week time frame, right? So you're saying managing a little bit earlier here, not really by a percentage of the credit you received, just net managing it earlier.
Yeah, that's exactly right. Yep.
Okay.
Just like we prefer to manage straddles at 25% of max profit as opposed to 50% for strangles, we can also manage them in less days than strangles. When we manage straddles at 14 days, we see an increased P&L per day with greater cumulative return and lower portfolio volatility. Even in different IV environments, managing straddles at 14 days, less days than a strangle, give us optimal performance. That's true. But doing it with high IVR was really the key.
I like it. Good job. I wonder how aggressive, because I'd like to do this on my podcast. So I wonder how aggressive we should be with the rolling. Do we still roll when we get to a delta of, say, 15 or 20? I would imagine so, right? You start out delta neutral. When do you roll the untested side to go inverted?
Yeah, but that's a big challenge. Like if you're doing the...
I know. That's why I'm asking it.
Yeah, if you're doing the dailies, you got to be super aggressive. If you're doing the 45 days, I don't think you can adjust on every tick. But you have to adjust if it gets out of whack.